we do is education. Number two is we'll provide options for individuals and families. So, are you seeing these companies pop up on the bottom?
Yes.
Do you recognize any of these companies?
Yes.
Awesome, awesome. So these are just some of the companies that we work with. So we ourselves, we're not the insurance company. We're not the financial firm. We're what you call an FMO, which is the financial marketing organization, which means that we can offer solutions from all the different companies, right? And then the benefit to the client is this: is that let's say AIG. Most people know AIG. You go directly to them. They're going to give you what they have, and then we're going to say the best thing for you is across the street at Fidelity, right? They won't do that. They're going to want to keep you there and get your business. Where with us, we can look at all the companies and actually find out which one is the best for the client. So now we can let the client know, hey, if you got a lot of money, go with this company. Or if you got a lot of kids, go with this other company, right? Everybody has different needs. We're able to figure out which of the companies best suits those needs, right? So that's what we'll do is we'll really just find what's the best thing, for that individual. And then when it comes to the services, there's a number of them we provide. But like I said, our biggest thing is education. So we always like to lead with a few key concepts just to help, provide some value for the individual if they never heard of it. These are some things that can literally put them in a better position right away. One of the first ones we like talking about is compound interest. Are you familiar with compound interest?
Yes, sir.
Okay, awesome, awesome. So it's one of those things where like everybody needs to know about it. It's where you get to the point where your money is making money. Which unfortunately not everybody's doing that. Most people the only way they know to make money is if they work for it. Which if that's the only way you're making money, now there's a limit to how much you can make. Why? Because there's a limit to how much you can work, right? But if your money is making money, how long can that work? Right? 24 hours a day, 7 days a week, doesn't need to take any breaks, right? So we really try to show people how they can do that, utilizing compound interest. So we have this thing called the Rule of 72. All it is a simple formula that shows you, depending on what interest rate you're getting, how long is it going to take your money to double, right? Now, I always like to ask this question. Let's say you had an extra ten or $20,000. Where would you put it?
Probably in my Roth IRA account.
Okay, nice. I like that. I like that. That's a way better answer than I usually get. Usually top two answers that I get when I ask this question is usually the bank, right? If not the bank, it'll be like under my mattress, right? Those are always the top two answers that I
Or
get.
I dump it
You know,
into my HELOC.
what say it again?
I'll dump it into my HELOC.
The heat lot. What is that?
It's a home equity line of credit.
Okay, got you. So it's one of those things where, like I said, a lot of people don't know different options as far as what they can do. And unfortunately, most of the options that people do choose is not the best options available. But the first thing that I always like to show people is number one, you got to pay attention to what interest you're actually getting on that money. Where let's say, for example, the bank. Most people have a bank account. Do you think most people know what the average interest rate is they're getting on their bank account?
No, they don't know. They don't know that it's just sitting there doing nothing,
Correct, correct.
losing value actually.
Exactly, exactly. Where most banks giving less than 1% interest. So then even at 1% interest, if you were getting that, which most people aren't going to be getting, that means it's going to take that money 72 years to double. Where if the person was 29 years old with $10,000, if they were getting only 1% interest, that means it would, by the age of 101, they'd finally have 20,000, which is not a good deal, right? But then at 10% now, that money can double every 7 years. Where the same person, if they was 29 with 10,000, 7 years later it'll double and double again to where by the time they reach retirement would have over 300,000, right? 7 years after that, over $500,000, right? And that's not putting more money into it. That's a one-time investment of 10,000. Where I always like to highlight this because most people save, but how you save can make all the difference in the world, and a lot of people just don't think about that. So we always like to try to highlight, hey, pay attention to number one, what interest you're getting. Number two is how your money's actually growing, right? So money will usually grow one of three ways, which is usually going to be fixed, variable or indexed, right? And each of these have their different advantages. I always like to tell people it's not like one is horrible and one is awesome all the time. It really just depends on the situation. So, for example, with the fixed account, the great thing about the fixed account is your money's safe. That's most likely what you're going to get from the bank. It's probably going to be a fixed account. Your money's safe, but the problem is your money's not really growing. So it's safe. That's a good thing. Bad thing, your money's not really growing. Now, the next thing is the variable account. which is what most people are familiar with the stock market, or most 401ks, or most IRAs even. They're usually connected to a variable account, to where the good thing about it is you can make a lot of money. But then what's the problem with the variable accounts?
The problem is it's a risk
There's
involved.
a risk. Exactly. You can also lose money. Now, does that mean you shouldn't put any money inside something like this? No. What we're saying is don't.
Scared money don't make money.
Yeah, it's true, but at the same time, you don't want to be foolish with your money. Let's just say that, because there's a lot of times where you can risk all your money and then lose all of it. As a matter of fact, one of my clients we sat down with a week ago, right? This is somebody where they're about to retire, had a 401k, was working with the company for about 30 something years. They're about to retire in like another couple months. And in the last 2 months, they lost close to $100,000 in their retirement in 2 months.
Is it
And
because
this
of
is
COVID?
somebody,
Is it because of COVID?
well, just no, because what's going on with the economy.
The
So the
market,
economy,
right?
yeah, exactly. I mean, I don't know if we're gonna blame that on COVID but still, either way, the economy is we're like officially in a recession right now, to where the market has been down for a number of months,
Well,
and
he's
then
not the
so
only one who lost money. The whole industry, the whole
correct. Yeah, no, that's my point. That's my point. And so everybody, shoot, everybody who's invested in crypto, everybody who's invested in, things that are connected to the market, yeah, right now is not a good time. As far as if they have money in the wrong vehicle. I'm not saying it's gonna be like this forever, but that's just what's going on now. And then for people who are like closer to retirement, it becomes a bigger issue because they don't got time to make that money back. So then, like I said, literally within like close to 2 months, she lost like close to 100,000. Which is something, like I said. Not saying don't have money invested, just don't put all your money in something like that. It's a portion of your money that is fine to, where you have it at risk, but not 100% of it. Right now, a preferred method of where someone's going to put a bulk of their money for us is something attached to an index. Are you familiar with the index?
I didn't take my securities license, so I'm not that familiar with it. I know of it.
Okay. Okay, awesome. So with the index strategies, right, what'll happen is this: is if you see the green lines going up and down, that's the market. But then if you see the black lines, that's the person's money. So then when the market is doing good, they're making good gains on their money. But when the market it drops, now it locks their money in place, right? So then with an index strategy, the person can put themselves in a position where they never lose money. And I always ask, why wouldn't everybody put their money in something like this? Simple answer is most people never heard of it. I would say about 80% of the people that I sit down with don't know about an index strategy, and it's literally one of the best investments that someone can make. And
So give me an
what I
example of an index strategy. What would be the name of that?
so for example, like you said, you had a
A
Roth
Roth
IRA,
IRA. Is
right?
that
So
index?
well, no, it's
That's
not.
variable?
It could be any one. That's the thing.
Oh, so
So
we have to
Roth
figure out
IRA.
which one do I have.
Exactly. Yep. So Roth IRA could be a fixed Roth IRA, a variable IRA, or an index one. So they have all three. So you just got to know which one is which one
I'm not
it is.
sure which one I have.
But that's one example. So most I would say the top two places that somebody can invest in an index is going to be through different retirement vehicles, whether that be an IRA, whether that be an annuity. There's different types of retirement vehicles where you can get index strategies, and then the second one will be through insurance. Right, so somebody can get something called an IUL, which is an Index Universal Life, which is a type of insurance policy that builds cash, and then all that cash is invested in the index strategy. So those are gonna be the top two. There are a couple other ways, but that's like the top two. That somebody can get. So like I said, once again, our goal is just let people know things like this exist. And unfortunately, not everybody even knows that they have these types of options, right? And then this, I'm actually not gonna go into this one. But last thing I'll show you is this right here, which is I'm assuming at some point in time you'd want to retire. Yes.
Absolutely.
Now, if it was up to you, when would you want to retire?
I guess retirement age 65.
65. Nothing wrong with that. Nothing wrong with that. Now, more important question: how much money would you need to retire at 65?
That's what me and my husband was talking about. Like if we still have coming into the house like 150,000.
Okay. Oh, so you pretty much say, do you want the same thing that you have coming in? But now here's the thing: if you don't have a guaranteed way of money coming in, that would mean you would need a lump sum of money that you're going to be getting distributions from. Yes.
Correct.
Now sometimes, like you say, if you have a pension set up, or if
Yeah, we
you
got a
create your own
pension.
pension, then you'll know, okay, this amount of money is going to be coming in. But
Well,
if
my
you don't have
husband is
something,
transit supervisor.
okay, no, that's fine.
Yeah.
But what I'm saying is, you just got to be clear about, okay, what is that going to look like?
Well,
You
oh
get what I'm
yeah, we're
saying?
talking
Yeah,
about that because we're
yeah.
up there, and we're he's looking to retire